Francisco-based First Republic Bank announced plans to lay off up to 25% of its workforce. The news came as the bank released its first quarter earnings. The bank also reports depositors pulled out more than $100 billion out of the bank, believing that First Republic could be the third bank to collapse after Silicon Valley Bank, and Signature Bank in New York. The bank made a partial recovery after several large banks stepped in and made $30 billion in uninsured deposits. First Republic now says 1,800, though, of its 7,200 workers could lose their jobs as it restructures. Joining us now to talk more about what this means for the banking industry and consumers, Jim Wilcox, economics professor at UC Berkeley's Haas School of Business. Good morning, Jim. Thank you for joining us on this. First, let's talk about the consumers, because we've talked this morning about how social media has played a role and kind of driving some hysteria. The reality is most of these people who are pulling out their money probably have less than $250,000 in an account, which is secured by FDIC, right?
Yes, that's right. The small depositors have absolutely nothing to worry about. And small is, for many of us, quite large. That is, as you mentioned, the insurance covers each account up to $250,000. But for a lot of these banks, especially those like First Republic, that cater to the high income, high wealth groups and cater to businesses and not cater to small depositors, there's some chance that they might lose, and therefore they can find other safer alternatives that are more lucrative.
And let's talk about that, because we have a lot of small businesses. Certainly that is the next item of concern, you know, on top of consumers, the small business owners. And you're talking about saving these banks, protecting their money. But we've talked about in the past, too big to fail. Is there too small to fail? Should there be some consolidation in the banks? Should these investors move their money, these small businesses move their money to the bigger banks?
Well, I think the depositors who have large deposits, and a lot of small businesses would have deposit amounts that are considerably larger than the deposit ceiling. And they do, I think, reasonably move to these larger banks on the argument that they will be safer there. But in addition, what's also happened is it's almost been a wake-up call to the higher interest rates that are available for liquid funds elsewhere. And that's why we've seen hundreds of billions of dollars move into money market funds, into treasury bills, and all kinds of investments that are even outside the banking system, but that are paying interest rates in the range of, say, 4 to 5%. And that's what's really hurt banks like First Republic.
There's talk of some investigations into these banks, and maybe some of the money from the banks, the executives at these banks have donated quite heavily to special interest groups, lobbyists, and, you know, frankly, political parties that are trying to limit regulation on the banks. Do you think investigations will come up with something into some of these banks and what's going on?
I don't know if they're likely to come up with any sort of nefarious activities or not. The problems that these banks have mostly have just come about because interest rates rose rather rapidly over the last year or so. And some of these banks were just asleep at the wheel, to be charitable. And therefore, they have had to pay the penalty for it. And so some of this is just old-fashioned bad business decisions, even if there was nothing untoward going on.
Okay, that's good to hear, because I did want to address that. There's some talk about that. Let's move on to, starting in May, there's going to be some changes to the loan structures, and quite specifically tying it to your credit score. And there's talk of people with a higher credit score would not be as likely to get a loan. Now, I know the idea is to help low income. Why not target and help specifically low income borrowers, first time borrowers, maybe like the college acceptance where you're a first generation home buyer, as opposed to tying it to credit score, because this seems to penalize people who work hard to get a good credit score?
Well, the announced plan is, as you say, to basically charge more to those with better credit scores and to charge less with those who have worse credit scores and credit records. And this is just part of a deliberate policy decision to make housing more affordable for those groups that have worse credit scores and lower down payments, perhaps. The difficulty that they have is in effect, they need to make changes that won't ultimately hurt these companies too much, like Fannie Mae and Freddie Mac and so on. And so they are, to some extent, robbing Peter to pay Paul, so that it's closer to a break-even operation. So this is just an attempt, really, to deliberately make housing, mortgages in particular, more affordable for some groups. And they could have targeted, as you say, just to those in particular without trying to make it more difficult for those with higher credit scores. But they chose to try to rob Peter to pay Paul.
Yes, I think the concern is squeezing out that middle class once again, paying the price there. So we'll keep following this. Jim Wilcox, economics professor at UC Berkeley's Haas School of Business, thank you so much for joining us this morning.
Thank you for your interest.